Hi, my name is Jimmy Connor and I'm with Bloor Street Capital, which is a corporate access firm based in the city of Toronto. Today I have the pleasure of introducing you to Sandip Rana. Sandip is the Chief Financial Officer of Franco-Nevada. Sandip, thank you very much for joining us today.
Thanks, James. Pleasure to be here. First of all, I want to thank yourself and Bloor Street Capital for hosting us. So absolutely, it's a pleasure to be here. Before we do start, as you mentioned, there is a presentation. There is a cautionary statement, which I will refer to, as there could be forward-looking information in the presentation. So read this fine print at your leisure. So I'm the Chief Financial Officer of Franco-Nevada. I've actually been with Franco, or rejoined Franco in April 2010, and have been here since in this role. I was actually with the original Franco-Nevada back in the late 90s to 2002 when we merged with Newmont. I took a bit of a hiatus from the mining business. I went to Four Seasons Hotels, different industry, but actually a royalty company. So I went from one royalty company to another, and then I'm back. So just to give you a bit of history on Franco, Franco was actually started in 1983 by two gentlemen, Pierre Lassonde and Seymour Schulich. And they started it as if it was any typical mining company with the goal to do some exploration, find a deposit, maybe build a mine and make some money. Along the way, they decided that the best strategy was to buy royalties. And they bought their first royalty in 1985 on a property called Goldstrike. It was owned by a junior mining company, and they bought the royalty for $2 million from a third party. And it had 600,000 ounces of gold on it. I think it was like 6 months to a year later, American Barrick, which is Barrick Gold Corp, came in and bought that property. And they drilled it, and they found the high-grade zone. That 600,000 ounces turned into over 50 million ounces of gold, and it was a company maker for Franco. And it was a company maker for Barrick. And if you look at that one mine, how much wealth it has created for shareholders, and just in terms of philanthropy for Canada, it's quite unbelievable. Franco's been paid over $900 million so far on that $2 million investment. By the time it's said and done, it'll be over $1.2, $1.3 billion likely. So a real home run for Franco. So they did that for the next 18 years. 2002, we merged Newmont, Normandy, and Franco, became the largest gold mining company in the world. And then after 6 years, December 2007, Newmont decided that they wanted to divest of the royalty business. Senior management, Pierre and David Harkwell, put up their hands and said, we'd love to take it public. And here we are. So since December 2007, it's Franco-Nevada 2.0. And, we're still a royalty. Now we've added streaming to the business, but we're essentially the same business we were when we started back in the mid 1980s. We look at Franco as the gold investment that works. And on this slide here, you can see we're listed on the Toronto Stock Exchange and the New York Stock Exchange. But the compound annual rate of return is about 20% over that time frame from our IPO. Compare that to the NASDAQ and the S&P, we've outperformed. But actually, if you look at gold and the GDX, which is mainly the gold miners, we've significantly outperformed. So, our slogan is we're the gold investment that works, and I think this chart highlights that we truly are. Our philosophy is to do good deals, not to do deals for the sake of doing deals. And we think if we do good deals, our key stakeholders will all benefit. So obviously our shareholders, our community where we invest with our operators and our partners back into various projects. And then obviously our operators, as I mentioned, who we consider our partners. And I think over the last 13 plus years, we've demonstrated that we do invest well, and all three of those key stakeholders have benefited from that. In terms of our business model, we are not an operating company. What we do is we buy royalties and streams on key mining assets around the world. And what this allows us to do is benefit from exploration and expansion upside. So what happens is we buy a royalty and stream for a fair value today with the hope that over time more will be found. And that incremental is what we'd like to get for free, and we call it optionality. And because of that, we're not involved in day-to-day operations. So that means our management team can focus on new deals. We're not sitting in boardrooms dealing with day-to-day operational issues. We're still focused on how do we grow this company. But while we do that, we make sure that we're protected and we have adequate security and tenure of our assets. But what it does allow us to minimize is costs. Operators, they have cost inflation, and that does not impact us. So we minimize our cost exposure. Now you're seeing, talk about taxes being raised in countries, and especially in Latin America. That doesn't affect us directly. And so we think it's a great business model. And, I think we've proven it over a number of years how effective this model truly is.
And Sandip, when you talk about long-term optionality, you're just talking about finding another Goldstrike. You want to make a $2 million investment and try to make $1 billion.
That's correct. So, there's two types of optionality. There's geological optionality, which is what you said. You buy something today that's got X number of ounces on it with the hope that it becomes, X plus Y down the road. And then there's obviously price optionality. You can't control price optionality. Nobody has a crystal ball of where commodity prices are going. But on the geology, if you do your due diligence correctly and you have a good technical team, you can get pretty comfortable that more will be found over time. So, the business has grown in terms of competition. There's really 3 large players, ourselves being the largest and the first royalty streaming company out there. But you've got a lot of junior guys entering the space. But we do like to consider ourselves, different than all the other guys. And this slide sort of tries to highlight that, but I'll point to a couple of areas which we focus on. One is ownership. Our board and management own over $200 million of stock in Franco. It's a large component of our wealth. So when we do deals, we're really investing for ourselves. And so we only do good deals, or at least try to do good deals, because if we don't, it will impact us directly with our share price. So for us, we run this company as if we are owners, and that is reflected through our share ownership. The other element of that ownership attitude is the G&A. If you go back into 2007, 2008, I guess the first full year that we were public after the IPO, from that point to this point, G&A is still less than $30 million a year. For the last 2 years, it hovered around 28 million. We can run this business with 35 employees, and we think we can scale it even bigger by adding more assets and not really having to adjust our G&A. So, our key is to keep costs low and to continue to grow the company. Another element here on this slide is just our financial flexibility. We have a philosophy in terms of capital allocation. This is a very cyclical business. You can never predict where commodity prices are going to go. So for us, we do our best business when commodity prices are in a bear market, in a downturn. So going into that downturn, the key element for us is not to have debt on our balance sheet. Is to go into that downturn with as much financial flexibility as possible. So ideally, a significant amount of cash on the balance sheet and full undrawn credit facility available to us, because that is when operators will need money. When the equity markets are tight, debt's expensive, we're a viable source of capital at the time. That's when we'll do our best deals. And that's when we're open to leveraging up, and that's what we've done in the past. And it's worked well for us, and we don't plan to divert from that strategy. We like to use our credit facility as a credit card.
So Sandip, I just want to touch on this G&A because this is a very important element, and this is what makes the model so profitable. I'm sorry, what was the actual G&A number?
So for 2020, G&A was 28.8 million.
Right, and you're doing about $1 billion in revenues.
Mm-hmm.
How high do you think you can grow the revenues with the same employee count?
So I'd say over the last 5 years, we've added maybe 3 or 4 employees, in finance, maybe asset management. And our revenue's gone from, I think it was about 600 million to over $1 billion. I think we look at it more from the number of assets. I think we could double the number of assets in the company and only add a few employees. And again, it would be in finance and it would be in asset management. So the business is completely scalable. So if there's a commodity price increase, it really does flow through to the bottom line for this company. One area that gets a lot of attention these days is ESG, and rightfully so. We've been, it's been a core part of our business for a number of years. When we do due diligence, environmental, social is always part of our checklist and our review to ensure that whatever investment we're making is on the right side of the ESG side. As you can see from these rating agencies, we've ranked quite well: Sustainalytics, MSCI, and then even with our governance with Board Games getting it ranked #2. On the World Gold Council, actually, David Harquail, who was our CEO until last year, now is our chairman. He was actually the chairman of the World Gold Council when the responsible gold mining principles were created. And then last year, we did sign on to the Black North Initiative, which the goal here is to address and alleviate systemic racism. And so along with that, we actually made public a commitment that by 2025, 40% of our senior management and our board will be diverse representation. And we think it's a very good goal. But diversity has always been key to Franco. As you can see, I'm a visible minority. I've been here since 2010. Lloyd Hong is our chief legal officer. He's a visible minority. He's been here since 2012. So really 40% of our executive suite is already diverse. So we've always seen the benefit of that. And we're glad that corporate Canada is sort of realizing the true strength of that. Just here is just our team. It's not all full 35 employees, but it's a large component of that. Also, this highlights how we give back to communities, partnering with our partners, Core Mining, Glencore, Sol Gold. So we've invested with our partners in water management, education, health, mental illness, basically whatever initiative that our partners are looking at doing. We're happy to be part of the funding strategy there, and we see this part of our business continuing to grow. As we earn more money, we will give more back to community. So in terms of our portfolio, we have 406 assets. This was just over 100 when we went public in December 2007. So on the mining side, we've got 324. So 58 producing, they're generating revenue. 42 advanced, and 224 exploration. Now the exploration, I call them lottery tickets. We already spoke about Goldstrike and how that $2 million investment, the kind of return it's provided. But we've got a couple of others. Detour, again, it was a $2 million investment. We actually got our money back and retained a 2% royalty. It's got over 20 million ounces of resources up in Northern Ontario. When that mine is mined out, it'll pay us anywhere from $500 to $750 million. And then the other one is Tasiast. Again, $2 million investment, 2% royalty. It's on Kinross's operation in Mauritania. Again, it'll be $500 million plus. So that's a 3 and 58 track record. I've got 224 exploration. Do I know which other ones are going to be those home runs? I do not. But am I confident that we'll get some performers in there, some that really come to the forefront? I do. I just don't know which ones they are, but that is the hidden optionality in the company. And that whatever does materialize is fully paid for and it's completely free.
Sandip, I was just going to mention that you do have 42 advanced projects. You must have 2 or 3 there that you are very confident in what they might deliver.
Yeah, so I guess you are right. One is Hard Rock. Hard Rock is an asset that's just got recently purchased by Equinox and Orion from Premier Gold and Centerra. We have a 3% royalty. It's shovel ready. We're quite encouraged by that asset that will get the construction go ahead and start to contribute revenue to us in the next 4 years. There's the Ring of Fire in Northern Ontario. It's the largest, the highest grade chromite deposit outside of South Africa. We have royalties on the entire land package. Right now it's owned by Noront, but there's Wailu Metals is a private equity company from the owners of Fortescue that are looking to buy Noront. What you need there is a highway. Once that highway is built, that entire land package should be explored. We know there's nickel, chromite, platinum, palladium, copper, all there, and our royalties cover the land package. So, what's the time frame of that? I don't know, but whenever that gets explored and mines get built, we will do quite well on that. So I'm quite encouraged from that asset in the future.
And Sandip, when it comes to non-paying royalties and streams, what is the average lead time from acquisition to the start of payments for both explorers and also developers? Yeah,
so development companies obviously shorter. We look at when we're doing the deal, how pre-feasibility study, feasibility study, is this just mine financing for construction? So it can range, but typically within 5 years on a development co. If you look at Cobre Panama, we did that deal in 2012 and it was ready to be constructed, but we didn't receive our first revenue till 2019. So that was 7 years. On the exploration side, that can be decades. We're in this for the long run. I'll give you an example. Hudbay has an asset called Rosemont. It's a copper asset down in Arizona. We bought that royalty in the late 1980s. For about $800,000. You're talking almost 30 years since we bought that. Now we're just waiting permit, right? So when we do, if it does get built and permitted, the revenue will be $20 to $30 million a year for a couple of decades. So it's an $800,000 investment, but the return could be significant. So for us, it's all about geological optionality, get as much exposure as possible. The one area in this business you can never predict is timing. You just want to make sure that you do have the exposure, and that's our goal. So within the portfolio, there are 4 core assets. So this slide highlights the 4. Cobre Panama, which is our largest investment, $1.36 billion. Candelaria, Antapaccay, and Antamina. They are all copper assets in Latin America. And we received the precious metals byproduct on these assets. They're all 25, 30 years plus. We expect those mine lives to be further extended. And what these assets provide Franco is just a solid base of cash flow for decades to come. And they're all great operators. So this gives a very solid foundation for Franco.
Sandip, we're going through interesting times right now. We're coming out of the pandemic. Copper is at or near all-time highs. And we're starting to hear some rhetoric out of these copper producing countries, Peru and also Chile. And they're asking for more money from the operators. And I'm just wondering, are you concerned about this? Do you think this is going to be a trend going forward in terms of these countries asking for a change in economics?
Obviously you don't want to see it, but it's understandable. Miners do get targeted because you can't move the deposit and the capital sunk. So it's not like a manufacturing plant that you could just relocate. So they are at the mercy of the governments. For us, it doesn't affect us directly because we are a royalty streaming company. It's off the top. Whatever incremental taxes that get paid are on the account of the operator. And we're not liable for those. But what it can do is it can impact future decisions in terms of capital being spent on the property, expansions, etc. So there is potentially some long-term impact, but nothing imminent. I think what you'll see taxes increase, but not enough to discourage investment. But just enough that the government can say that they're getting more from the operators. But time will tell. We've seen this before in the last bull market in the late 2000s. You started seeing that with some of the countries as well. They started talking about the same thing, but then the market went south and it sort of fell away. So it's part of the business, but for us, there's no immediate impact. But it's not something that we want to see, but we do understand what governments are trying to do.
And a large percentage of your revenues are coming from the Americas. Are there countries that you tend to stay away from? Like, I'm just trying to look at country risk now. We just saw a Canadian gold mine in Kyrgyzstan that was nationalized. And do you have a list of countries that you just stay away from?
Yeah, so we don't want to go to places where we do think that expropriation could happen. So obviously you've seen that in Russia and the Stan countries. You've seen it in DRC. So we're not, those are areas we'd probably avoid. People talk about West Africa. We're happy to go into West Africa. It all comes down to diversification and what's the dollar number you're going to invest. So we're pretty open to most jurisdictions. Key for us, which I highlighted, earlier, was just security and protection. So you want to make sure that you're protected however you can. And then obviously it's the dollar size. For us, we love Canada, US, South America, Australia. Like that's our go-to places. But you go to where the deposits are. So we're open to most countries. We just got to make sure we protect ourselves. So with those 4 core assets and the rest of our portfolio, this is a slide that Bank of America actually prepares, and it looks at the reserve life. And you can see from 2015 to 2020, Franco's reserve life actually increased. So we're just under 19 years now for our reserve life. If you compare that to the senior gold producers and the intermediates, they've stayed relatively flat, around 11 or 10 to 11 for their reserve life index. So again, this just highlights the strong, profile of the company in terms of duration, and then on top of this, you can layer on that optionality, which I love this slide. So what this slide does is it really highlights what the true power of optionality is. And so what we've done here is we've taken our IPO portfolio, which was at the December 2007. We paid 1.2 billion to Newmont to pull it out. At the time, there was about 30 million ounces of gold on those assets. You fast forward to the end of 2020, there's about 70 million ounces of gold on those same assets. And that's after 39 million ounces of gold being mined. So if you do the aggregate, that's basically 30 million ounces has turned to about 110 million over that time frame. And we've received 1.6 billion in revenue. So this is just the same portfolio. This does not even include any additional transactions occurring. And this all occurred to Franco for free, because it goes down to our fundamental belief that assets, you will find more over time, and operators are encouraged to find more and drill and expand reserves and resources. And that's what this slide shows. And we have benefited from that with zero cost to Franco, other than what we paid at our IPO, 1.2 billion. So I think, when we did go public, I don't think we could have really envisioned how well the company has done. But if you look at our track record, our key financial metrics, GEOs, revenue, adjusted EBITDA, adjusted net income per share have all increased over time, really regardless of what the commodity prices have done, along with our market capitalization. But the one takeaway from this slide is our G&A, which we talked about a bit earlier. When you take our G&A and you compare that to our market capitalization, it's about 15 basis points. So if you compare that to your alternatives for gold, a gold ETF, you're paying anywhere from 20 basis points to 40 basis points. So, and all there you're getting is the price optionality. With Franco, you're getting the price optionality as well as the geological optionality, and you're actually paying less, which is 15 basis points. And as I said at the outset, we think we can scale this company and don't see G&A increasing significantly higher than what it is right now, and continue to grow the company. So we think that's a big takeaway for how we run this company.
Sandip, you just talked about geological optionality. We discussed that before, but how many people work on your technical team?
So overall in the whole company, it's 35. We like to say we've got the largest business development team in the industry, because really because we know we're not operators. Management's focusing on new deals, but you know, I would say 7 or 8. We've got geologists, mechanical engineers, you know, metallurgical engineer. So we've got a wide spectrum. If there's a skill set we think we need on a deal, we'll hire a consultant. But for us, you know, we think we've got a solid technical team, and a key part of that is then our technical team on technical committee with the board. You know, we have you know, Louis Janac and Catherine Farrow, and then as a consultant, Graham Farquharson, who we have to get by on any deal to get them on side. So yeah, I off the top of my head, I say 7 or 8 folks. So with our fixed cost structure, which that's how I look at it, you know, our margins are consistently over 80%. Actually, in first quarter this year, they were 85, and our net income margin was over 50%. Because our G&A is flat, our cost of sales will fluctuate, but our key component of our cost of sales is, you know, the cost we pay on an ounce we receive under a stream. So if we're paying more, that means we're getting more ounces. So it's actually a good thing. But as the commodity price moves up, our revenue goes up and our profit will go up. And I think you can see that on this slide going from 2016 to 2020. As the gold price has increased and precious metal prices have increased, our profitability has increased. And if you know, commodity prices continue to do well, our profitability will increase. And it's true, it really is a high margin business from both an adjusted EBITDA margin as well as an adjusted net income margin. In terms of capital allocation, obviously our number one objective is to continue to add deals to the portfolio, to you know, continue to grow this company, which we think we can do. But you know, after that is the dividend. And we're very proud of our dividend. We believe in a progressive and sustainable dividend. We've raised our dividend for 14 consecutive years. We've paid over $1.55 billion in dividends over that time frame. And actually, if you were an investor from the IPO, you're doing quite well on your dividend yield, just under 10% on a Canadian dollar basis and just under 8% on a US dollar basis. We just did raise our dividend. So for June, we've raised it 15%. For 30 cents per share per quarter. And as I said, we want to raise it each and every year. There's a lot of talk about tying your dividend to a formula as a percentage of cash flow. You know, we look at that and say, you know, if the commodity prices drop and cash flows drop, then your share price is probably going down, which means then your dividend's getting cut at the same time. We don't want to be doing that. Regardless of what commodity prices do, we want to be able to raise that dividend. And so far, we've got a 14-year track record of doing so. In terms of Franco, you know, one key takeaway is that we actually outperformed during the entire market cycle. So if you look at the bull market from 2008 to 2012, when the gold price, you know, peaked at $1,900 in 2011 and averaged about $1,600 in 2012, we outperformed both the gold price and the operators. And then if you fast forward to the bear market for 2013 to 2015, we were down, but we were down significantly less than gold price and the operators. And then now this new bull market that we think started in 2016, we've outperformed again. And so what happens is in a bear market, you know, access to capital is limited. So then we are a viable choice and we can grow the company with new deals. In a bull market, when operators and developers don't need our capital as much, we're less busy on the deal side, but what's happening is the money that's being raised through whether borrowing or equity or just cash flow from operations is being reinvested in either existing operations, new mines getting built, exploration drilling on our 200 plus assets on the exploration side, so you get organic growth. And so we can grow this company during the entire cycle. The other element of this is inflation. With our fixed cost structure, we're not really impacted by inflation, which is what you saw in the bull market from 2008 to 2012. As commodity prices went up, investors thought the operators were going to give them that high leverage to the gold price increase, and it didn't materialize. And a key component of that was inflation. cost inflation really limited the margin increase versus ourselves, as I've highlighted earlier, it flows down to the bottom line. So we can perform during the entire cycle.
Sandip, I'm glad you brought up inflation because we're seeing a lot of it now in terms of CPI numbers and PPI numbers coming out of the US, and everybody's seen the price of oil double in the past year. Copper is at or near all-time highs. The price of steel, wood, everything is going up. Are you starting to see this on the partner side?
So we haven't seen it yet. There's been some talk of it. We do have a couple of net profit interest royalties where we get a percentage of the profit. We're seeing a little bit there, but I think it's more of a story to come. It'll be a question of whether the operators can really stay disciplined in terms of maintaining their cost structure. But as you highlighted, everything is going up. I read something this morning that talked about the US purchase index was the highest it's been in decades. And you're right, everything is increasing and it will impact operating costs. It's just a question of how much. And as I've highlighted a few times, Franco is not really impacted by inflation. So if commodity prices continue to do well, Franco will do well. So in terms of where we are today, for 2021, we've got growth over 2020. Our guidance range for this year is 580 to 615,000 GEOs. Compare that to 520,000 we did in 2020. On the energy side, we did just over 90 million of revenue last year. Right now we're forecast 115 to 135 million. That's at $55 per barrel oil price. So obviously oil's over $70 a barrel now, so we'll be revising that guidance as when we release our Q2 results in early August. So we've got significant growth for this year, for 2021. If you fast forward to 2025, that GEO number increases to 630 to 660,000 GEOs. A key component of that is Cobre Panama. First Quantum plans to expand that to 100 million tons per year by 2023, so we'll benefit from that. And there's a number of mines that we expect to be in production. Solaris Norte with Goldfields is actually under construction right now. And then Hard Rock, Stibnite, and Valentine Gold, we expect those to be up in production by then as well. One is just waiting a construction decision. Stibnite and Valentine Lake are waiting for permits, but they're in good jurisdictions and will add incremental growth to the company. And then on the energy side, we do anticipate somewhat of a rebound in capital spend for drilling in the United States. And so, we're forecasting revenue to be 150 to 170 million by then. So when you factor that growth between the mining side and the energy side, that's 25% revenue growth for Franco-Nevada at $1,750 gold, $25 silver, and $55 oil. And this assumes no further transactions by the company. So, obviously we will continue to add assets and grow the company. So we've already got built-in growth. So we're in a very good position right now for the next 5 years.
Sandip, you made a very large investment in copper when it got hit between 2014 and 2016. Did you do the same thing last year when oil got hit?
Yeah, so what we did is we started investing in oil 2016 when it went down to $30 a barrel. We looked at where we could invest, so we made significant investments in the United States. Basically bought mineral rights on lands, private lands, which are the best mineral rights in the world, and we've done quite well. Obviously, what we've seen is capital flow decrease into the energy sector. But we are looking at oil. We've done more natural gas recently. Our last two deals were natural gas deals. One was in the Marcellus Basin and one was in the Haynesville in Texas. But we've spent significant amount on energy over the last 4 to 5 years. There's opportunities out there, but right now, our goal is 80% precious metals, 20% diversified, of which energy is a large component. We're getting close to that 20% limit. So, we'll still look at the energy sector, but we'll continue to just focus on precious metals for now. In terms of our growth profile, as I've highlighted, we do have the built-in growth, and the largest component of that is Cobre Panama. And this slide highlights the key 4 assets: Candelaria, Antapaccay, Antamina, and Cobre Panama, how they're expected to grow to 2025. And then besides those, we have a lot of organic growth. There's a number of mine expansions ongoing. The one we're really excited about is actually Detour. There's 2 pits at Detour right now. They've been doing some drilling on the saddle zone and hitting high grade. So we think eventually there'll be a super pit, and Kirkland Lake has talked about a super pit. So we could see a significant expansion of reserves at Detour, and where we have a 2% royalty. So that's exciting. Stillwater, a platinum palladium mine down in Montana. We have a 5% royalty there. So, where those prices are, and there's an expansion going on. So we're excited for that. And then obviously Subika, Macassa, Island Gold. So that's all organic growth to the company. And then new mines that, Seguela is a royalty we just bought recently. As I highlighted, Solaris Norte is under construction. Valentine Lake, Hard Rock, Stibnite. So, individually, these might not, move the needle, but when you start getting a number of these in an aggregate, and then you add that in with the Cobre Panama expansion, you get significant growth coming through to 2025. And then if commodity prices continue to outperform, we're sure there'll be other assets that'll do expansions and get good exploration results. Our most recent transaction, we ventured out into the iron ore space. We bought some royalty debentures on Vale's Brazilian iron ore assets. It's a land package that covers 1.7 million acres of land, and there's varying royalties by commodity on those lands. We consider these iron ore deposits best in the world, along with the Pilbara in Australia. Their long life reserves are about 30 years. And this allows us to share in that in the iron ore market. It'll be about 5% of our revenue this year. They are debentures, so the way they work is there's 2 annual payments, but the annual payments are based off of revenue. So it's essentially a royalty. There is no term on these debentures. They're basically for life of mine. And it was the Brazilian government that was selling them, and we were fortunate enough to buy a significant portion of those. So, we will show our first revenue from this asset in Q2. But based on the last premium payment, it was about 55 million in annual revenue, which is about a 10% pre-tax cash yield. So it's a good yield, and iron ore prices have done quite well since then. So we're quite encouraged, and long-term consensus is about $70 a ton iron ore. Even at $70 a ton, we'll do about 8% return on these long life assets. So it's another form of diversification for the company. When we did announce the Vale royalty debentures, we also announced our interest in LIF. We bought this over a number of years. Our average cost is $14.72 Canadian. LIF's trading, I believe, high 40s right now, so significant capital appreciation. With the dividend payment that we'll get in Q2, we've basically recouped our investment. We paid 93 million Canadian to acquire our 10% or 9.9% equity interest. Through the dividends, we've recouped our initial investment, so we've got our money back. The rest is all upside. These again are high quality, high grade assets, 24-year reserve life. They target European smelters, but they're long serving, have a long history, and so we're very happy to have added this to the portfolio and are now benefiting from the high iron ore prices.
Sandip, did you just acquire the 9.9% in the open market?
We did acquire in the open market. We were selective. We sort of had a price target of what we were trying to achieve, and we did it over a number of years. And as I highlighted, it was our average cost was $14.72.
And at the right price, would you take that number above 10%?
Initially, that was the plan when we went up to 9.9, but then we started looking at the Vale debentures. We would look at possibly buying more, obviously not at the price that it's at right now, but if you had a significant pullback over time, we would be more than happy to buy more. Again, great assets, great jurisdiction, great operator. For us, it ticks all the boxes in terms of geological optionality, long life. So yes, absolutely, we would consider it down the road. In terms of our firepower, when you look at our working capital at the end of Q1, obviously we did the Vale transaction. The goal will be we did draw down on the credit facility to help fund with this. The goal will be to have that facility paid off by the end of June. But when you factor in all the elements, we've got about 1.2 billion in available capital still to deploy. And at these commodity prices, we're generating significant cash flow on a quarterly basis. So we've got ample firepower to continue to add to the portfolio, and we're pretty confident we can continue to do so.
So Sandip, you got a lot of cash to deploy. What's the pipeline looking like right now? How many deals are you looking at, and what size are those deals?
So it's actually pretty active. A year ago, you had a number of $1 billion deals as the copper price dropped significantly or quickly, and base metal guys were looking at beefing up their balance sheets. There were larger transactions. I would say those large transactions are not there right now, but you're seeing a lot of $100 million to $400 million deals, and it's a combination. You've got base metal guys that are looking at expansions, maybe new mines getting built and looking at ways to finance them. You've got gold development companies, again, who have assets now that are looking to build them, and how do you finance them? You've got a bit of M&A where companies are looking to do acquisitions, and how do you finance those acquisitions? So it's a wide spectrum. You've got gold opportunities, you've got diversified. There's always energy opportunities as well. But right now we're focused on precious metals, but I'd say it's pretty active.
And in a typical year, let's say 2020, how many deals would you look at?
I'd say, we probably look at, like at a high level, we will touch anywhere from 80 to 100. And then you'll probably do more of a deep dive on, say, 20 of those with really detailed due diligence on, less than 10, with a number of term sheets going out, and then being successful on a handful. Last year we did the Sol Gold deal in May, and that was the main transaction. But since the beginning of this year, we've added the Haynesville natural gas transaction. We've added another precious metal stream in Peru with a private entity. We've done the Vale iron ore assets. We've done the Sequela royalty. So this year we've already deployed $850 million of capital. So at the end of the day, it's got to be a good deal. Some years we spend more, some years we spend less.
And you made a point of mentioning your technical team and doing due diligence, how important that is. This environment that we find ourselves in, are you still able to conduct due diligence on a deep level? Are you going to site?
So it depends on the jurisdiction. So certain jurisdictions, we've been able to charter a plane and fly down for a day or two, do our due diligence and fly back. Some other jurisdictions where it's a bit more challenging to cross borders, we've either done some virtual due diligence, or we've been fortunate enough to have consultants within country who we trust to go to site and do some work for us. So it's a combination. Nothing does beat on-site due diligence by your own technical team, but we are in a difficult time right now. So, I think there's been a lot of learnings in what can be done remotely versus on-site. So I think you'll see some virtual due diligence going forward, but we've tried to do what's available to us depending on the jurisdiction.
And Sandip, there's been a lot of new competitors coming into the space in the last few years. A lot of them are smaller royalty companies, and we just had a larger one go public here in the last month. All this new competition coming into the space, is that hindering your business at all?
So It's true, competition has increased. I think from our standpoint, we like to break it into buckets. So if you look at deals that are $500 million plus, it's really the three large guys, ourselves, Wheaton Precious, and Royal Gold, with ourselves being the largest. And within that tier of 100 million to 400 million, you definitely have more competition, such as the company that did the IPO. You've got some private equity, so you have more competition there. Where we're really seeing the large increase in competition is in the small space. Deals that are a few $1,000,000 up to 50, 60 million dollars. You're definitely seeing more competition. We still win our fair share. What all we can do at the end of the day is not divert from our valuation strategy, and look at the geological optionality and upside, come up with our fair value, make an offer. If we're successful, great. If not, what we found is that when we do lose deals, we don't lose them by a small amount. It's usually quite significantly higher than what we were bidding, and in that case, we're happy to lose because we want to pay fair value of what we think is there.
Sandip, as we wrap up here, why don't you just tell us what we can expect in terms of news flow here in the coming weeks and months? Sure.
So for us, we will be releasing our Q2 results on August 11. As I mentioned, it'll be the first quarter where we will have the revenue from the recent Vale transaction. So that'll be a significant increase on our revenue for Q2. And then after that, it's just a case of, what's the deal pipeline and whatever news comes with that. But as you highlighted, James, and we spoke about, the pipeline is active. A lot of opportunities out there, and we'll do our best to be successful on a few of those and hopefully announce something in the near term.
Sandip, that was a great overview of the Franco-Nevada story, and I want to thank you for taking the time. And to all the viewers who took time to sign in and listen to the Franco-Nevada story, I want to thank you. I know your time is valuable and we do appreciate it. Once again, Sandip, thank you.
Thanks so much, James. Thanks for having me, and it was a pleasure.